All right, let's jump right into this explainer. I've got my expert investment analyst hat on today, and we're taking Tesla's massive Q1 2026 financials and throwing them right into the ultimate value investing gauntlet. We're taking one of the most hotly debated stocks on the planet and applying the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some strict discounted cash flow modeling just to see what the raw math actually tells us.
Here's our roadmap. We're going to hit a company snapshot, look through the Buffett, Lynch, and Graham lenses, run a DCF valuation, and then synthesize the whole thing.
Section 1. Company Snapshot. Let's set the stage with exactly where Tesla stands right now in Q1 2026.
It's honestly fascinating to consider the sheer scale of this operation today. They generated a solid $22.38 billion in revenue, up 16% year over year, by the way. They pulled in $1.44 billion in free cash flow and delivered over 358,000 vehicles in just 3 months. But here's the kicker. That massive $1.45 trillion valuation? Yeah, that tells us the market expects a heck of a lot more than just moving metal.
Which brings us to a massive pivot. Elon Musk and CFO Vaibhav Taneja announced Tesla is entering a multi-year phase of heavy capital investment. They literally raised their 2026 capex forecast to an astonishing $25 billion. Why? Because they're betting the farm on autonomy. They're pouring cash into AI compute, humanoid robotics, and autonomous robotaxis like the Cybercab.
Section 2. The Warren Buffett Lens. Let's see how the Oracle of Omaha would view this high-tech pivot.
You know Buffett, he absolutely loves an economic moat, consistent earnings, and manageable debt. Well, Tesla passes the balance sheet test with flying colors. They're sitting on a mountain of cash, $44.7 billion in cash and short-term investments, making debt practically a non-issue. Plus, they've got a killer moat with nearly 8,500 supercharger stations and 1.28 million active full self-driving subscriptions. But the earnings consistency? That's highly volatile, constantly taking a hit from price cuts and massive R&D spending.
So if we try to calculate Buffett's famous owner earnings, we can take their Q1 operating cash flow, roughly $3.9 billion, and subtract that super aggressive maintenance capex. We land right around their reported $1.44 billion in free cash flow. It's positive, sure, but if you annualize that, it doesn't even come close to justifying a $1.45 trillion price tag with any real margin of safety. Buffett would almost certainly just sit on the sidelines for this one.
Moving on to Section 3. The Peter Lynch Lens. Let's see how the master of growth at a reasonable price tackles this. Lynch always categorized companies first to understand how they behave. Historically, Tesla was the ultimate fast grower. But today, at a $1.45 trillion market cap, Lynch would probably reclassify them. They're transitioning into a stalwart because hypergrowth is just inherently harder at that massive scale. But they're also kind of becoming an asset play because the real hidden value isn't in manufacturing cars, it's in their unprized AI and robotics IP.
And here's where we hit the Lynch friction, the good old PEG ratio. That's the price to earnings multiple divided by the growth rate. Based on Q1's non-GAAP net income of $1.45 billion, their annualized PE ratio is sitting at a sky-high 250x. Even if we generously grant them a super optimistic 20% long-term growth rate, the PEG ratio is well over 12. Lynch wants that number down near 1. So under his strict traditional criteria, this is a glaring immediate sell. Section 4. The Benjamin Graham Lens. Time for the strictest test of all from the father of value investing.
Graham's defensive investor checklist is famously unforgiving. Now, Tesla easily passes on adequate size and strong finances. But it fails instantly on 2 major fronts. First, it pays absolutely no dividend. And second, its price-to-earnings and price-to-book multiples are just astronomical compared to Graham's conservative limits. When we punch the numbers into Graham's famous intrinsic value formula, taking the square root of 22.5 times earnings per share and assuming an industry average book value of $25 per share to fill in the missing data gap, the output is an intrinsic value of roughly $17.10. Compare that to the $410 share price implied by their current market cap. There is literally zero margin of safety here. Graham wouldn't just avoid this stock, he'd probably run in the opposite direction.
Section 5. DCF and alternative valuations. Pure value investing rejects it. But we need to look forward, not just backward.
Let's build a base case discounted cash flow model. If we take that Q1 free cash flow and establish a base of about $6 billion annually, and then forecast a very aggressive 20% growth rate over the next 5 years, assuming their energy storage and FSD software really scale up. We map out some sharply rising cash flows.
But here comes the reality check. When we discount those future cash flows back to today, using an industry-standard 10% weighted average cost of capital, and tack on a 3% perpetual growth rate after year 5, well, the math still only justifies a fraction of the current $1.45 trillion valuation. The model is super sensitive to these specific inputs, obviously, but practically no standard DCF gets you to $1 trillion+ based on their current cash generation.
Let's try another angle, an alternative multiple model. If we take the Q1 adjusted EBITDA of $3.66 billion, annualize it, and compare it to their massive enterprise value, the EV to EBITDA multiple nears 100x. Just to put that into perspective, traditional auto peers usually trade closer to 5x or 10x. This definitively tells us the market is absolutely not pricing Tesla as a car company. It's pricing it for absolute AI perfection.
Section 6. Synthesis and final recommendation. Let's bring all these analytical lenses together. Bringing it all together into a master synthesis reveals a pretty stark consensus. Based purely on the grounded Q1 2026 financial realities, every traditional and quantitative framework we used is flashing warning signs. Buffett says wait for a margin of safety. Lynch says sell, it's overvalued. Graham says do not touch it. And both the DCF and EV to EBITDA models scream severely overvalued. At a $1.45 trillion price point, the current financial fundamentals simply do not support a buy rating.
However, and this is a massive however, these traditional models fundamentally struggle to price in the future. Tesla's balance sheet is a fortress with $44.7 billion in cash. Their active FSD subscriptions skyrocketed 51% year over year, and they are actively rolling out unsupervised robotaxis. These are huge strengths, but they are actively battling immense risks, like that insane $25 billion capex burn, fierce competition in China, which makes up nearly 19% of their revenue, and operating margins that have compressed down to just 4.2%. Ultimately, what you should really take away from this explainer is one vital question for your own portfolio. Tesla is no longer just a standard auto manufacturer. It's essentially a $25 billion venture capital bet on an autonomous future bankrolled by a legacy EV business. So, are you investing based on the grounded traditional financial math of today, or the limitless, unproven AI robotics of tomorrow?